Today we want to talk about a very interesting topic brought up by a guy by the name of Michael Burry, famous for the book The Big Short, famous for the big short of CDOs, collateral debt obligations, which triggered the GFC and the stock market crash that happened. So the big question is, will ETFs cause the next stock market crash? Paul?
Well, let's look at some of those concerns, Peter, and we'll come back to Burry in a moment. But the first thing, just talk about the index tracking ETFs. There's over $5 trillion globally invested in these index tracking
Huge growth.
ETFs. And in the US at the moment, they're now as big as active investing. This chart from Morningstar shows the growth of active management versus passive management versus active management. Passive management and active management in 2018 almost the same, and probably in 2019, if you just took that chart a bit forward, they'd be maybe the passive would have overtaken. So it's now absolutely huge industry in the way fund managers invest. Burry is one of many people that have sort of been citing concerns. He's talked about bubbles. He's saying the longer it goes on, the worse the crash will be. Another well-known CEO from Double Line has called it a herding behaviour. So there are a lot of sort of concerns from sort of prominent market participants. Let's look at some of the actual specific concerns. The first one is about price discovery. And what Burry is saying here is that because ETFs just buy a whole lot of stocks,
200 stocks or 500
and whatever
stocks.
the price is, there's no actual price discovery. That is when buyers and sellers are trying to work out what a company is really worth. Yeah. And risk is not being accurately priced. That means that people can overpay for a company simply because it's in an ETF, because an ETF needs to buy, maybe paying a lot more than the company is really worth, or conversely. So
and I think it adds to volatility on the way up and on the way down.
Yeah, so that's the first point. And then secondly, that he's saying that there's a whole lot of money tied up in these index tracking ETFs, actually indexed to stocks with low liquidity. So take, for example, the most well-known index in the world, the S&P 500. You can get the S&P 500 here through IVV. But he says that of the 500 stocks that make up the S&P 500, 266 have daily liquidity of less than $150 million per day. But yet there's sort of trillions of dollars riding on the ETF in what are arguably very illiquid, relatively less liquid stocks.
Yep.
So if the ETF needs to be unwound and needs to sell those stocks, there's not a lot of liquidity. So he says that that's some issue. Thirdly, he says there's a lot of derivatives now around ETFs and their use of structured assets. That could make it worse. And then finally, there's some concerns around so-called sovereign risk, or perhaps unnatural owners. And the example quoted here is that, for example, with Japanese equity ETFs, the Japanese government owns about 80%
it's staggering,
of all
isn't it?
Japanese equity ETFs.
So there's a lot of unknowns there, aren't there?
There are some unknowns. Let's actually put that in context. I mean, first of all, I think, in fairness to Burry, he's perhaps arguably talking his book a little bit. He is a small cap fund manager.
He's an active fund manager.
An active fund manager, so he's got a bit of an axe to grind. So let's look at what he said. Are ETFs likely to cause or trigger a crash? I think that's pretty unlikely, Peter. I think we can rule that out. I think it's possible that ETFs could exacerbate a correction. That is, if the market starts to go down and investors out there are saying, I'm also worried about my holdings. They want to get out of their ETFs. ETFs have to sell stocks. That could actually push the market down. Now, that actually happens on the way up as well. So you could argue that's just
and also fund managers have to sell too when their clients want to get out. So it's not as though it's going to be the first time ever there's going to be wholesale selling from fund managers. There's just more passive ones.
Now, the way that doesn't become too big an issue is in that sort of scenario, likely that the bid and offer spread on the ETF will widen. Now, ETFs use market makers to help keep the ETF trading at a very narrow price relative to what it's really worth, the so-called NTA. That's great in a tight, normal, low volatile market. In a more volatile market, those spreads will tend to widen, and they actually will stop some of the selling. So that's actually could be, in some ways, a bit of a perverse positive. It means if you want to get out, you're going to be probably selling at a price below NTA, but it will actually stop some of the selling. I think the bigger impact on sort of ETFs in a bit of a crash type scenario will be on small cap stocks, simply because they are low liquidity, and if the ETFs do have to unwind, we could get some big swings in prices there.
But of course, that creates buying opportunities for hedge fund managers and people like that who see ridiculously low prices on good stocks, albeit small caps, and that can be an offsetting effect. But I do agree the volatility increases both ways with ETFs.
I think if you are worried about ETFs, and I'm not suggesting you should be, but I think that still the same thing applies in all these markets. Always stick to ETFs on the major ETFs, particularly those with really good and strong underlying issuers.
Yeah.
Stick to those which have got benchmark indices that are well understood and respected by the market.
Like the ASX 200 or the S&P 500 indexes.
And then I always caution this, don't invest in synthetic or exotic ETFs.
Unless you're a thrill seeker.
Unless you're a thrill seeker. And some of the synthetic ETFs are where they're using futures that are then tied to some underlying stock, so you're 1 or 2 steps removed from the market. There are a lot of ETFs in the US on all sorts of things. We don't have them here in Australia quite to the same extent, but I think in a market liquidity crunch, they could be tested. So again, stick to the trusted, the proven names, those better quality issuers.
Yeah, I largely agree with what Paul was saying. I do think ETFs will increase the volatility in both ways of the market. But I will make at the point that Ray Dalio, one of the greatest investors in the world, he buys ETFs as well.